Imagine waking up one morning and your savings app won't open. Your bank is temporarily unavailable. The stock market plunges 40% in a single day, and your retirement, decades of hard work, vanishes with a single algorithmic trade. Sounds impossible? That's exactly what people thought in 1929. But here's the twist. The same forces that broke the world once are building again. Debt, greed, delusion. Except this time, the world is faster, digital, and far more fragile. So before we go deeper, I want to know, do you think America could face another Great Depression? Drop your thoughts in the comments, yes, no, or already happening. Because this story might decide how prepared you really are. The late 1920s felt like a miracle. Factories hummed, cities grew, radios and cars appeared in households by the millions. The Dow Jones Industrial Average climbed to heights few had ever imagined. It reached its all-time peak that year on September 3, 1929, at 381.17 points. People talked about stocks at dinner. Clerks, school teachers, small farmers, all bought shares. Buying on margin became the engine of that boom. Brokers allowed investors to purchase stocks with only a fraction of the value up front, sometimes as little as 10% down, effectively borrowing 90%. That leverage multiplied profits on the way up, and it would multiply losses on the way down. Then October arrived. The first alarm came on Thursday, October 24, 1929, a day history would call Black Thursday. Heavy selling began. The ticker lagged behind reality. Panic spread through the crowd outside the exchanges. Traders who had been cautious were suddenly swept up in the stampede to sell. 2 days later, on Monday, October 28, 1929, the market plunged even deeper, Black Monday, as desperate selling resumed. And then on Tuesday, October 29, 1929, the market imploded, Black Tuesday. In a single day, millions of shares changed hands in frantic liquidation. Paper fortunes vaporized. The Dow, which had looked invincible just weeks before, began a collapse that would not bottom for years. What seemed like an isolated market event quickly revealed itself as something far worse. Credit dried up. Banks, many of them small regional institutions that had lent heavily to local businesses and speculators, began to fail. Depositors, frightened and uncertain, rushed to withdraw savings. Between 1930 and the worst of the crisis in 1933, thousands of banks failed, wiping out depositors' money and destroying confidence. By 1933, unemployment in the United States had soared to roughly 25%. 1 in 4 workers could not find a job. Real economic output plunged, industrial production and GDP contracted sharply, and millions of families faced eviction, hunger, and ruin. Leaders struggled to respond. Early policy responses were confused and at times counterproductive. It was only after 1933, with a new administration and a set of reforms known collectively as the New Deal, that the federal government began building safeguards most Americans now take for granted. Deposit insurance, bank regulation, large-scale public works that provided jobs. The Federal Deposit Insurance Corporation, FDIC, created in 1933, guaranteed bank deposits and helped restore the basic trust people need to keep their money in banks. But those fixes took time and came at enormous human cost. The shock of those years left an imprint not just on the economy, but on the nation's politics, culture, and institutions. The lesson seared into public memory was simple and brutal. When leverage is high, confidence is everything. And when confidence collapses, the damage is not limited to portfolios. It spreads to factories, to farms, to families. So remember those dates: September 3, 1929, October 24, October 28, and October 29, 1929. They are not just markers in a history book. They are the moment when an era of boundless faith in markets became a demonstration of how quickly a system can fail when too many people borrow too much and trust is lost. Now let's move to the present, 2025. America, the engine of global finance, stands taller than ever on paper, but the foundation underneath is trembling. U.S. household debt has reached an all-time high, more than $18 trillion. Mortgage balances alone make up nearly $13 trillion of that number, while credit card debt sits at roughly $1.2 trillion, the highest level ever recorded in American history. Auto loans and student debt keep climbing too. The average family now owes more money than at any other time, and a growing share of that debt carries variable interest tied to a rate that can change overnight. Globally, the picture is no better. Total debt across households, companies, and governments has risen to a record $338 trillion, about 235% of the world's total GDP. That means, for every single dollar the planet produces, there are more than $2 already owed back. And at home, Washington's own books tell a similar story. The U.S. national debt has surged to nearly $38 trillion. The government now pays over $1 trillion a year just in interest, more than America spends on defense in some years. Economists warn that within a few years, interest payments could become the single largest item in the federal budget. Debt to GDP stands at roughly 125%, the highest peacetime ratio in modern U.S. history, and projections suggest it could exceed 140% by the end of the decade. So what happens when the world's strongest economy starts running out of fiscal oxygen? For now, confidence keeps everything moving. As long as people believe the system works, they borrow, spend, and invest. But belief is fragile. Wages have barely kept pace with inflation. Housing is increasingly out of reach for younger Americans. The cost of living, healthcare, food, energy, continues to rise. And with interest rates higher than they've been in 2 decades, debt has become a weight pressing down on nearly every household. One lost job, one medical emergency, one unexpected spike in rates, and the ripple could turn into a wave. What's unnerving is how familiar this all feels. Just like the late 1920s, we're watching a mix of record optimism and quiet anxiety. Credit expanding, assets inflating, and the belief, always the same belief, that this time we've built something unbreakable. But history has a way of testing those who forget. And if 1929 was the warning shot, 2025 might be the echo that reminds us how fast confidence can vanish.
In every boom, there's a moment when the old rules stop making sense. When analysts warn of risk, but the crowd keeps buying. When logic whispers, slow down, and the market screams, not yet. In 1929, that moment came with ticker tape euphoria and borrowed money. In 2025, it arrives through glowing screens and artificial intelligence, faster, louder, and far more seductive. The U.S. stock market has never looked this powerful. Tech giants dominate the landscape, with companies like NVIDIA now valued above $4 trillion. And the Magnificent Seven, Microsoft, Apple, Amazon, Meta, NVIDIA, Alphabet, and Tesla, make up more than a third of the S&P 500's total value. Never before has so much depended on so few. Investors are no longer betting on what companies earn today, but what they might earn tomorrow. The promise of AI has become the new gold rush. Every startup claims it's building the next revolution: faster chips, smarter models, limitless potential. U.S. tech spending is expected to exceed $2.7 trillion this year, driven by AI, automation, and data center expansion. And yet, beneath the excitement, even seasoned investors admit what few dare to say aloud: valuations are starting to defy gravity. Surveys now show more than half of global fund managers believe we're already in an AI bubble. The technology sector trades at nearly 50 times its earnings, far above historical norms. The higher the valuation climbs, the thinner the safety net becomes. Because the market, at its core, is a confidence game. It runs not on profit, but on belief. And belief, once shaken, can vanish overnight. The pattern is hauntingly familiar. In 1929, millions borrowed to buy stocks they didn't fully understand. Today, millions invest in technologies they can't even explain. We call it innovation, but at what point does innovation become speculation? Behind the glossy headlines are startups valued in the billions without a working product. Announcements made before prototypes exist. Investors chasing buzzwords instead of business models. One analyst compared it to a digital gold rush built on digital sand. And the danger? This time, it's invisible. In 1929, panic spread through crowds outside brokerage houses. In 2025, it spreads through phones. Instant, silent, relentless. No shouting traders, no newspaper headlines, just one notification. Your portfolio is down 40%. What makes bubbles so dangerous isn't greed, it's the illusion of control. The belief that we can outsmart history, that technology changes everything, that old rules no longer apply. But history doesn't forget. It waits. Because every boom, every wave of confidence ends the same way. When investors stop believing there's a game being played at all.
We tell ourselves today's markets are safer because they're smarter. Rules, models, circuit breakers, algorithms that never sleep. It feels like control, but modern control is mostly speed management, not risk removal. Start with the guards at the gate. U.S. stock markets now use market-wide circuit breakers that halt trading if the S&P 500 falls 7%, 13%, or 20% from the prior close. Single stocks are governed by limit-up, limit-down bands that automatically pause violent moves. These tools can slow the fall, but they don't change why people are selling or what happens when trading resumes. Settlement is faster too. In 2024, the U.S. moved to T+1 stock settlement, shrinking the time between trade and cash. That reduces some counterparty risk, but it also compresses liquidity, forcing brokers and funds to post cash and collateral sooner. When volatility spikes, that tighter window can turn a routine wobble into a scramble for dollars. Then there's who is trading. In U.S. equities, roughly half of volume is executed by automated or high-frequency strategies. They provide liquidity until they don't. When signals flip, machines back away together, spreads widen, prices gap. We've seen what speed can do. The 2010 flash crash erased nearly $1 trillion of equity value in minutes before bouncing back. In March 2020, circuit breakers tripped multiple times as pandemic fear cascaded through passive funds and derivatives. Halts slowed the plunge. They didn't stop it. The plumbing has changed too. Passive funds now control more than half of U.S. equity fund assets. Index investors don't ask, what is this company worth? They buy or sell the whole basket, all at once. That concentration amplifies movements in the largest stocks and tightens the feedback loop between flows and prices. Derivatives add another layer. The explosion of same-day expiring options, 0 DTE, means intraday hedging can mechanically yank the market around. When dealers must hedge a wave of calls or puts, they buy high and sell low by design, turning a ripple into a surge. And panic doesn't travel by newspaper anymore. In 2023, a single regional bank saw tens of billions in deposits vanish in hours, not by lines at the door, but by group chats and mobile apps. That was a preview. Today, with instant payments and trading apps, fear can move faster than any policy response. Even our safety valves can backfire. Trading halts bunch orders at the reopen. Price bands shove volume into darker corners. Faster settlement pulls forward funding stress. What looks like control can become synchronized strain. So yes, the dashboards are brighter. The rules are tighter. The code is cleaner. But the truth is simpler. We didn't eliminate risk. We accelerated it. And when belief slips in a digital market, the fall doesn't echo across a trading floor. It flashes on every screen. At once. Debt used to be a bridge, something you crossed to build a factory, buy a home, start a life. Now it's the road we live on, and the bill shows up every mile. Start with the federal ledger. The national debt is now in the mid-$30 trillion and climbing. Annual interest costs have pushed past $1 trillion, consuming a larger slice of the budget than many cabinet departments combined. As a share of the economy, federal debt sits well above 100% of GDP, roughly a quarter higher than America's post-war norm, and projections show it drifting even higher through the decade. Here's the spiral people don't see. More debt, higher interest costs. Higher interest, bigger deficits. Bigger deficits, more treasury issuance. More issuance, investors demand higher yields. Round and round it goes, unless growth outruns interest, or spending and revenues are rebalanced. Complicating that math is the maturity wall. Treasuries don't last forever, they roll over. With the average maturity measured in years, not decades, a meaningful chunk of low-rate debt issued in 2020 to 2021 has to be refinanced at today's higher yields. Even if rates stop rising, the cost rises as old bonds mature and new ones price at current levels. Who buys all this debt matters too. The Federal Reserve is shrinking its balance sheet, no longer absorbing treasuries at crisis levels. Foreign holdings from nations like Japan and China have flattened or fallen as a share of the total. That leaves more debt in the hands of domestic investors, banks, money market funds, pension systems, insurers, who demand yields that match risk. When supply is heavy and demand is cautious, yields don't fall, they rise. Now, shift to households. Total household liabilities now exceed $18 trillion, with mortgages making up the largest share. Credit card balances are at record highs, with average APRs in the 20% range, the highest in decades. Auto loans are larger and longer than ever, and delinquencies are climbing, especially among younger and lower-income borrowers. Student loan payments, paused for years, are back, squeezing monthly budgets already stretched by food, rent, healthcare, and gas. Mortgage rates near multi-decade highs have frozen the housing market. Owners won't sell their cheap loans, buyers can't afford today's. Debt payments absorb the oxygen that should have gone to savings, emergencies, or small businesses. Corporations aren't immune. Big investment-grade companies are holding steady, but lower-rated firms face harsher reality. Interest coverage shrinks, refinancing gets harder, mergers slow, hiring pauses. Expansion plans go back into the drawer. In the leveraged loan market where loans float with interest rates, every Fed rate hike drains cash directly from company earnings. States and cities feel it too, as tax revenue slows and municipal borrowing costs rise. Pension funds, chasing return for a decade, are now juggling lower asset values with higher payment obligations. Zoom out, the machine works like this. When interest rates stay above economic growth, debt ratios rise, unless governments run real surpluses. When we use inflation to erode debt, central banks raise rates, which often cancels out the supposed relief. And when markets sense that a country won't change course, they don't wait for a crisis report, they reprice immediately. That is the spiral. Not a sudden explosion, but a tightening noose. Refinance at higher rates, interest bills expand, choices shrink. The longer we postpone repair, the more repair will cost. In 1929, leverage hid in margin accounts. In 2025, it's woven through governments, corporations, and households. And because it's everywhere, there is no single valve to turn, no rescue button without consequences. Debt can power prosperity when it funds creation and productivity. It becomes a trap when it funds permanence, the belief that tomorrow will always pay for today. Bridges are meant to cross. We turned ours into a loop. If you want to see the stress lines in an economy, don't look at stock charts. Look at the household ledger. Start at the top. In the United States, the top 1% now hold roughly a third of all household wealth, close to the highest share in modern records. The bottom half of Americans combined hold only a small single-digit percent. The average wealth figure looks healthy, but that's because the richest inflated. The median family tells a very different story. The middle is thinner than it used to be. A generation ago, most Americans lived in what we called a middle class. Today, fewer do. More households have slipped downward or risen sharply upward. The center is disappearing. Real median household income has struggled to keep up with cumulative price increases since the pandemic. And daily life is where that gap shows up. Housing. Rents have soared compared to 2019, in many cities by dozens of percent. Mortgage rates are near multi-decade highs. For first-time buyers, this is the least affordable housing market in a generation. Nearly half of renters are now cost-burdened, spending more than 30% of their income just to keep a roof overhead. Debt and cash flow. Credit card balances are at record levels. Typical APRs are above 20%. Delinquencies have climbed from their pandemic lows, especially among younger and lower-income Americans. Auto loans are longer and larger than ever. Student loan payments, after years of pause, are back. Savings rates are near historic lows. Costs that don't wait. Health insurance premiums and deductibles are near record highs. Childcare, groceries, utilities, car insurance all have seen steep increases since 2019. Families don't feel inflation slowing, they feel prices that stayed high. Job stability. Yes, employment is low, but real take-home pay doesn't stretch as far. Many people are working 2 jobs. Others rely on gig work to survive. One missed paycheck, one car repair, one medical bill, and a household falls into overdraft and debt. This is how inequality turns into fragility. At the top, assets compound. In the middle, fixed costs like housing, healthcare, and debt consume most income. At the bottom, there's no margin at all. And when interest rates rise, the pain doesn't hit everyone equally. Those who borrow feel it first. Those who own feel it last. An economy can grow while its center thins, but not forever. A strong middle class isn't just a statistic. It's a shock absorber of a nation. When that absorber wears down, every bump in the road feels like a cliff.
In a tightly wired system, it doesn't take a crisis to make a crisis. It takes a spark. Confidence spark, the fast bank run. In March 2023, a single regional lender saw tens of billions in deposits attempt to leave in a single day after doubts spread online. What once took weeks, people lining up at bank doors, now takes hours inside a group chat. Real-time payments and mobile banking compress panic into the speed of a push notification. Liquidity is a mood. When it flips, money moves faster than policy. Market structure spark, thin ice under heavy feet. U.S. equities have circuit breakers that pause trading at -7%, -13%, and -20%. Single stocks have price bands that halt extreme moves, but these are breaks, not fixes. They slow motion, they don't change direction. And when trading resumes, the same flow of orders can push prices even lower. Options add more fuel. The surge in same-day expiring options, 0 DTE, forces dealers to hedge intraday. When markets fall, hedges often trigger more selling, mechanically turning a dip into a drop. In bonds, it's worse. Rising yields shrink collateral values, trigger margin calls, and force more selling, which pushes yields higher again. Plumbing spark, funding and collateral strain. We've seen the pipes shake before. In September 2019, overnight repo rates spiked, forcing an emergency Fed intervention. In March 2020, liquidity vanished even in the U.S. Treasury market, the world's safest asset, until the Fed stepped in. In 2022, UK pension funds using leveraged strategies faced sudden margin calls when bond yields surged, nearly collapsing the system. Different countries, same mechanism. When leverage meets volatility, the system sells what it can, not what it wants. Commodity spark. Real economy whiplash. On April 20, 2020, U.S. crude oil futures settled below $0, not because oil became worthless, but because storage ran out and contracts had to unwind immediately. When time and balance sheet capacity disappear, mechanics overpower fundamentals. Rating and auction spark, the price of doubt. A sovereign downgrade doesn't change a country overnight, but it can change investor rules overnight. A weak treasury auction, too few buyers at expected yields, can send rates higher within minutes. Higher rates ripple into everything: mortgages, business loans, government budgets, stock valuations. Digital asset spark, contagion without borders. In crypto, confidence can break in hours. We've already seen a major stablecoin lose its peg over a weekend and only recover once banks reopened on Monday. People treated it like cash, but it traded like risk. And when it cracked, the shock hit tech stocks, funding markets, and investor sentiment beyond crypto. Transmission is the story. Social media turns rumor into action. Algorithms and passive flows turn small moves into mechanical waves. Collateral and leverage turn price drops into forced selling. Liquidity providers vanish right when they're needed most. None of these sparks require fraud, or a major bank failure, or a war. All they need is speed, leverage, and a moment with no buyers. In 1929, fear traveled by newspaper. In 2025, it travels by API. The next break may not begin with a headline. It may begin with a notification. And by the time you read it, the first wave will already be over. History doesn't just warn, it instructs. After 1929, the U.S. learned the hard lessons and built guardrails: deposit insurance to stop bank runs,
securities laws to curb the worst abuses, a stronger lender of last resort at the Federal Reserve. Later reforms added stress tests, resolution plans for big banks, and rules so that losses hit shareholders and bondholders first, not taxpayers. Today, standard deposit insurance remains $250,000 per depositor per bank. Brokerage accounts have SIPC protection up to $500,000, and the Federal Reserve still has tools like the discount window and the standing repo facility to pump liquidity into frozen markets. But guardrails don't steer the car. We still choose the road. At the national level, the choices are clear and hard. Stabilize the fiscal path. When interest rates stay above economic growth, debt ratios rise unless we cut deficits. That means being honest about spending and taxes without crushing growth. Lengthen and ladder public debt. Spreading out when treasuries mature reduces rollover risk, especially as low-rate debt from 2020-2021 gets refinanced at higher rates. Invest in productivity, not illusions. Spend on infrastructure, technology, energy, education, things that make tomorrow stronger, not just calm today. Contain non-bank leverage. Shine light on private credit, derivatives, repo markets, and leveraged loans where stress hides outside traditional banks. Keep market plumbing functional. Ensure clearinghouses, collateral systems, and liquidity backstops work under strain without promising to rescue every investor who took a bad risk. In the private economy, the signals are simple. Lenders must price risk honestly and keep enough capital and liquidity, especially mid-sized banks that aren't too big to fail. Corporations should avoid balance sheets that only work at 0% interest rates. Refinance while they still can before markets close the window. Investors must know the difference between cash flow and hype. Concentration looks like genius on the way up and disaster on the way down. And households? Their choices aren't dramatic, but they matter. Prefer fixed rates over variable when possible. Build emergency savings measured in months, not days. Pay down high-interest debt because a 20% APR is a slow-motion market crash. Diversify across assets and time. Sell some euphoria, buy some caution. Know your protections, what banks insure, what brokerages don't. None of this guarantees safety, but it improves the odds. The mistake of 1929 wasn't just too much debt, it was denial. People saw the signs. They just chose not to believe them. We can drift and let arithmetic choose for us, or act and choose for ourselves. History is generous. It gives the same lesson until we learn it. This is the moment to listen.
Maybe nothing happens tomorrow. Maybe the markets keep climbing. The banks stay open, the dollar holds strong. Maybe the system lasts longer than the people warning about it. Or maybe, like every cycle before, it turns when most people stop paying attention. Because when the crash comes, it doesn't send an invitation. It doesn't warn you with fireworks or headlines. It just arrives, quietly, like a tide taking back the shore. And when it does, it won't just test our money. It will test our trust. Trust in our institutions. Trust in each other. Trust in the idea that effort leads to security. That's the real fragility of our time. Not inflation, not interest rates, but whether people still believe the system is fair enough to fight for. So before you click away, ask yourself, if everything changed tomorrow, would you be a witness to it or a casualty of it? If you believe history often repeats, comment, history repeats. If you still believe America can adapt in time, comment, we'll find a way. But here's the part most people forget. History doesn't only record collapse. It records rebuilding. Every crisis this country has faced, 1929, 1973, 2008, was followed by something else. Reinvention, new rules, new industries, new leaders, new ways of thinking. Yes, the system is strained. Yes, we are standing close to the edge, but we are not helpless, and we are not done. Preparedness is not fear. It's responsibility. Learning from history is not pessimism, it's wisdom. And the future isn't written yet. That part is still in our hands. This doesn't have to be the end of the story. It could be the beginning of a better one, if we choose to write it that way.